This graph shows a phenomenon we've been discussing on this channel for quite some time. The dollar has lost value throughout this year. For example, compared to the euro, it has lost nearly 16% of its value so far this year. With respect to other emerging market currencies, such as the Brazilian real, the trend has been similar, with the U.S. currency losing value relative to its peers. But for many, this situation has gone unnoticed, despite its tremendous impact on their investments. For some individual investors who invested in S&P 500 indexed ETFs or U.S. stocks at the beginning of the year, the returns may not be as expected because they didn't consider the dollar's loss in value when calculating the returns on their investments in local currency. This behavior and the reality of the causes of the loss in value of U.S. index ETFs have been evident this year, and we have tried to show it on this channel. In this video, we'll review the current situation of the dollar and what could happen in the coming months. One of the best ways to observe the phenomenon of the dollar's depreciation is by reviewing the DXY, or dollar index, which compares the dollar against other currencies, such as the euro, the yen, and the pound sterling. It's clear how, over the course of the year, the index has gone from values close to 110 to currently 96. Now, what's interesting to analyze is how President Trump's recent statements could continue to cause the dollar to lose value, and what the consequences could be for investments in the U.S. stock market and equities. On the one hand, it's clear how President Trump is insistently seeking to have the Federal Reserve lower its interest rates. As we reviewed in other videos, he is seeking lower rates for the U.S. government's new debt. The high deficit and debt levels are worrying, and one way to try to control them is to seek lower rates at which short-term bonds are renewed. And these rates directly depend on the Federal Reserve's interest rates. But on the other hand, the Fed, or Federal Reserve, under Jerome Powell, has recently been quite reluctant to implement rate cuts as President Trump intends. Among other reasons, one of the most important is that the Fed wants to ensure that the recent increase in tariff rates does not generate inflationary effects. While recent data shows that inflation has been controlled for now, it is possible that the Fed is monitoring the inflation data for June and July, as inflationary effects are generally not immediate. And on the other hand, the so-called trade war is not completely over. Although there is a partial truce, especially with China, it is still unclear what tariffs will ultimately be imposed on imported products. For these reasons, it is possible that the Fed, led by Powell, has been cautious, waiting to have enough information to determine whether the tariff increase will ultimately cause price increases. In support of President Trump's claims, inflation levels have been quite positive so far, and oil prices are under control, which would offset the potential increase in some products. But some analysts believe these developments have led President Trump to lose patience, as a prompt reduction in interest rates is likely essential for him, both to seek better terms for renewing short-term debt, and also as a tool to allow for a rapid economic recovery, especially considering recent information reporting that the decline in the U.S. economy was greater than initially reported for first quarter. The actual contraction in the gross domestic product was 0.5%, the lowest economic growth in recent years. President Trump has repeatedly harassed Federal Reserve Chairman Jerome Powell on social media, using terms like moron and repeatedly threatening to fire him. According to the Wall Street Journal, President Trump will seek to announce soon, in September or October, the name of a potential replacement for Powell when his term ends in 2026. But for other analysts, the real possibility of President Trump hindering the independence of the Federal Reserve is not very high. And for some, Trump's statements regarding monetary policy are more likely to seek media attention. However, these attacks on the independence of the Federal Reserve may be one of the factors, along with high levels of debt and deficit, in addition to the trade war, that have led to the collapse of the dollar throughout this year. Recently, at the NATO summit, President Trump stated that he already has 3 or 4 people who could replace Powell. Among the most prominent names is Kevin Warsh, who served as governor of the Federal Reserve in previous years. Warsh also has an important academic background and has been a vocal critic of the Fed's prudence in rate cuts. He also holds a closer view to President Trump's regarding monetary policy management. Warsh was even nominated for the Fed's presidency in 2017, but was defeated by Powell. But what is truly important in this discussion is whether, in addition to President Trump's continued pressure on Powell to lower rates, the possible appointment of a person who does not guarantee the independence of the Federal Reserve is added. While many believe the dollar's decline is reaching support levels, the uncertainty surrounding the election of the new Fed chairman could add further downward pressure to the U.S. currency. But on the other hand, we must not forget that the choice of the new Fed chairman must be confirmed by the Senate, which could help ensure that a nominee is not selected who simply follows the president's orders. Additionally, Fed decisions are made by 7 governors and 5 of the 12 Federal Reserve Bank presidents, where decisions are made by majority vote. That is, decisions regarding monetary policy are made by 12 members. But on the other hand, some analysts believe that having a new Fed chairman could cause the market to perceive the Fed as partially biased in favor of the president and lose credibility and trust, leading to another drop in the dollar. We must not forget that the Fed chairman is the one who sets the agenda for the Fed meetings known as the Federal Open Market Committee, FOMC. But on the other hand, it is possible that President Trump himself is trying to keep the dollar weak to promote exports and improve the trade balance. While this strategy may not seem to be working for now, in fact, U.S. exports fell by 5% in the first quarter of the year. Along these lines, in some statements, President Trump asserted that the strong dollar has been an obstacle to recovery of the U.S. industry he wants to foster. Trump even stated that a weak dollar would allow the restoration of the glory of U.S. industry, returning the United States to the golden age. But other analysts believe this view is mistaken and could cause the dollar to lose its reserve currency status against assets like gold, which has recently reached record highs. Even the renowned economist Barry Eichengreen, a professor at the University of California at Berkeley, has gone so far as to say that the trust and dependence on the dollar that has been built over more than half a century is at risk and could be lost in the blink of an eye. Some media outlets have even reported that there is a hidden plan proposed by one of President Trump's advisors, Stephen Miron, to keep the dollar weak by trying to boost domestic manufacturing in the United States, promote exports, and reduce the trade deficit, which is at truly high levels. And according to this proposal, the dollar's status as the world's most important reserve currency has not been an advantage. On the contrary, it has been a burden that has led to the deindustrialization of the United States, as it has made products manufactured in North America more expensive. But for other analysts, such as Kenneth Rogoff, a professor at Harvard University who worked for the International Monetary Fund, Trump advisor Stephen Miron's diagnosis is flawed. For Rogoff, the U.S. trade deficit is not solely due to the strength of the dollar, which, while it may be one factor, is not the only one. He has also criticized the Trump administration's proposal as a magic bullet to solve America's fiscal deficit problem with increased tariffs. For now, the big question remains whether the dollar's loss of value is a temporary phenomenon or whether, on the contrary, we should begin to get used to a weak dollar. If this would be a prolonged period of dollar weakness, it would not be the first, as the dollar steadily lost value between 2001 and 2011. During that period, the DXY index fell from 117 in 2001 to nearly 70 in 2011. A similar situation occurred in the late 1980s, when the DXY index fell from 150 in the mid-1980s to nearly 80 in 1992. These two periods demonstrate that historically, there have been prolonged periods of dollar weakness. The other implication of the situation has to do with decision-making regarding investments in dollar-denominated assets. As we saw at the beginning of the video, an investor in euros holding S&P 500 index ETFs has lost around 16% due to the currency exchange rate. Although the S&P 500 index has already appreciated around 5% this year, the loss in value would not be offset by the euro-dollar exchange rate. Likewise, as we discussed in another video, it would be interesting to explore investment alternatives outside of American stock markets, both in emerging market stocks and even in commodities. For now, the real probability that President Trump could remove Fed Chairman Jerome Powell is very low, as the law only allows for his removal in the event of proven misconduct, lack of capacity, or corruption, and the term expires in May 2026. However, the noise generated could affect the markets, as has already been seen, and continue the weakness of the dollar, a situation that must continue to be closely monitored to make the best investment decisions. For now, what is certain is that the hypothesis of a weak dollar has been fulfilled, and the caution of investing in U.S. assets is warranted. Remember that in the video description, you will find a link to the best course to learn technical and fundamental analysis for investing in stocks. There's also a link to the best platform for buying stocks on the stock exchange, regulated in the United States. If you enjoyed the video, give us a like, subscribe to the channel, and share the content.